Before we talk about expert advisors, VPS hosting, backtesting, or automated trading, we need to start with the product that many MT5 traders are actually trading: CFDs. CFD stands for Contract for Difference. At its simplest, a CFD is a trading contract that allows you to speculate on the price movement of an asset without actually owning the asset itself. So if you trade a CFD on gold, you do not own physical gold. If you trade a CFD on oil, you do not own barrels of oil. If you trade a CFD on an index, you do not own the companies inside that index. What you are trading is the difference between the price when you open the trade and the price when you close the trade. If the market moves in your favor, you make a profit. If the market moves against you, you take a loss. That sounds simple, but it is a powerful idea. CFDs allow retail traders to access markets like forex, gold, oil, stock indices, commodities, shares, and even crypto-style instruments, all from a single trading platform. They also allow traders to go both long and short. In other words, you can buy if you think the market is going up, or sell if you think the market is going down. That flexibility is one of the main reasons CFDs became so popular. CFDs originally developed as a professional trading product used by institutional traders and hedge funds to gain market exposure without directly owning the underlying asset. But as online trading platforms became more advanced, brokers started offering CFDs to retail traders. Suddenly, markets that were once difficult for the average person to access were available from a home computer. That changed the game. Instead of needing separate accounts for different asset classes, traders could access multiple markets from one platform, often with real-time charts, technical indicators, and fast order execution. But the feature that made CFDs especially attractive was also the feature that made them dangerous: leverage. Leverage allows a trader to control a larger position with a smaller amount of capital. For example, with 20-to-1 leverage, a trader may be able to control a $20,000 position with only $1,000 of margin. But here is the key point. Your profit and loss are based on the full position size, not just the margin you put down. That means leverage can amplify gains, but it can also amplify losses. And this is where a lot of beginners get into trouble. Leverage is not free money, it is amplified exposure. A small move in the market can have a much larger impact on your account than expected, especially if your position size is too large. That is why risk management is not optional in CFD trading. It is the foundation. Another important concept is negative balance protection. In some regulated jurisdictions, retail clients are given protection so that their account should not fall below zero. That means if there is a sudden market move, the trader should not owe the broker more than the funds in the account. But negative balance protection does not make CFD trading safe. It does not stop you from losing your account balance. It simply helps protect against going into a negative account balance under certain conditions. So the right way to think about it is this: negative balance protection may stop the account from going below zero, but it does not stop poor risk management from taking the account to zero. Now, there are clear advantages to CFD trading. You get access to multiple global markets. You can trade rising or falling prices. You can use leverage. You can trade from one platform. And for active traders, the ability to trade instruments like XAU-USD, forex pairs, indices, and commodities from the same environment is incredibly convenient. But there are also serious disadvantages. Spreads matter. Commissions matter. Swap fees matter. Slippage matters. Execution quality matters. And broker choice matters. Some brokers operate as market makers. Some offer ECN-style or raw spread accounts. Some use hybrid execution models. And depending on your country, regulation and product availability can vary dramatically. Popular retail CFD and forex brokers include names like IG, CMC Markets, Pepperstone, IC Markets, FP Markets, 8cap, Oanda, Forex.com, AvaTrade, Plus 500, eToro, and others. But this is not about recommending a broker. The important point is that traders need to understand who they are trading with, how orders are executed, what fees apply, and what protections exist in their jurisdiction. Now, this brings us to MetaTrader 5. Because CFDs gave retail traders access to global markets, but platforms like MT5 gave retail traders access to something even bigger: algorithmic trading. Not long ago, automated trading was mostly the domain of banks, hedge funds, proprietary trading firms, and institutions with developers, infrastructure, market data systems, and execution technology. Retail traders simply did not have the same tools. MT5 helped change that. With MetaTrader 5, traders can analyze charts, use custom indicators, build scripts, run expert advisors, backtest strategies, and automate trading rules using the MQL5 programming language. That means a retail trader can create a strategy, define the entry rules, define the exit rules, test it against historical data, and then run it automatically on a live account. And with VPS hosting, that strategy can run continuously without depending on a home computer being switched on. This is where CFD trading and algorithmic trading intersect. CFDs provide the market access. MT5 provides the trading environment. Expert advisors provide the automation. And VPS infrastructure provides the stability needed to keep the system running. But automation does not remove risk. In fact, it can amplify both good and bad decision-making. A strong strategy can be executed with discipline, but a flawed strategy can lose money faster because the machine does exactly what it is told to do. No hesitation, no second guessing, no common sense. That is why understanding the product matters before building or running automated systems. You need to understand the market. You need to understand leverage. You need to understand execution. You need to understand your broker. And you need to understand the limits of your strategy. So, to summarize, a CFD is a contract that lets you trade the price movement of an asset without owning the asset itself. CFDs became popular because they gave retail traders access to multiple markets, long and short trading, leverage, and online execution. But they also carry serious risk, especially when leverage is used without discipline. MT5 then opened the door for retail traders to take the next step, building, testing, and running algorithmic trading strategies through expert advisors. And that is what this channel is about. MT5 Algo Lab is here to explore the tools, strategies, infrastructure, and real-world mechanics behind algorithmic CFD trading. Not hype, not magic, not push-button riches. Just the lab work behind building better systems. In the next video, we'll take a closer look at MetaTrader 5 itself, what it is, how it works, and why it became one of the most important platforms in retail algorithmic trading.